All right, Nike just reported earnings. In the headline, Nike runs past earnings estimates despite slumping sales in China. Stock as of right now is up about 0.75% after hours. It was down 2% today. So the question is, how is the earnings report? Am I interested in the stock? I don't own it. I'll be upfront about that. I share my portfolio all the time, so just check out the rest of the videos. Subscribe to the channel. We do full portfolio updates every Friday. But the question really is Nike sold off quite a bit. A lot of stocks have, and does it look like a good investment after these earnings and with what the future might look like in this kind of crazy macro environment? They reported 90 cents in earnings per share against 12.2 billion in revenue. That beat on both earnings per share and revenue. Analysts were expecting 82 cents and 12.1 billion in revenue. They had strength bolstered by 7% boost in direct-to-consumer revenue. And so really what they talked about, their inventories are up because of some of the supply chain issues we know about. The sales in China were down. That's presenting kind of some headwinds to the business and some risks to the business. Inflation is up, so their shipping prices were higher. That brought their gross margin down 80 basis points to about 45%. But huge is they just announced an $18 billion buyback program over the next 4 years, which kind of replaces that $15 billion repurchase program they had that was going to expire in fiscal year 2023. So management is saying they think the stock is cheap. They're going to continue to buy shares back, which investors are going to like. And so if we just look historically, over the last 10 years, Nike has outperformed the market 16% compound annual growth rate versus 11. If we go out to max, 21 years, has absolutely destroyed the S&P 500, 16% compound annual growth rate versus just under 7. So in total, you've gotten on a $10,000 investment, you've made $18,000 in dividends over the past 20 years, $218,000 in stock price appreciation for a total return $236,736. Amazing. $10,000 to $236,000. This is what's awesome about dividend growth though. If you would have invested in 2002, you would have been getting 6 cents per share, which would have been about a 1.16% yield. Fast forward 20 years, you're now getting a 22% yield on the cost of shares that you purchased in 2002. And that happened because they have grown the dividend on average 15% per year for the last 21 years. So that's the magic of dividend growth stocks. That's the magic of dividends. And it's a really strong argument for orienting towards dividends and dividend growth stocks. Morningstar gives Nike a 4-star rating. They call it 15% discount to fair value, wide economic moat, exemplary capital allocation. If we take a look, this is just a rough look, right? But over the past 20 years, they've grown earnings at about 14% per year. And moving forward, they're actually going to be above that on average. I mean, who knows? These might come down because of kind of the macro environment. But the average PE has been 23. It's currently trading at 30. So yes, above its average. But if we look out to what expected earnings are going to be, just through 2025, 5/31/2025, you're looking at a 10% annualized rate of return for a 33% total return. So if somebody's looking to be invested, looking for a dividend stock, a dividend growth stock, and some capital appreciation, some share price growth, I won't argue that Nike could be a great opportunity, especially because of that buyback authorization, the strength of their brand, the strength of the balance sheet. You know, there is a risk that this thing comes down and trades in line with its blended, its normalized price to earnings ratio. I mean, clearly if investors would have bought it around that average over the years, then, you know, back in 2017 through now, even after this drop, you've made 16% per year. Generally, when investors we're trading at about a 30 PE now. And so you could see over its history, this thing does get above its average PE, but it tends to come down. And so if we look back to 2014, traded right about a PE of 30. And really, you know, it jumped up a lot. It got up to about 32. That would have been a pretty nice return through 2015. But eventually it came back down, right down to its normalized PE of 23, 24. And so over that time, still 8% return, which is nothing to sneeze at. And if you held it long term, you're doing fine. But investors have done well kind of just waiting for this thing to come in line with its normalized PE ratio. So, you know, if somebody's cautious on this stock, they're nervous about it, and they would be more comfortable waiting. It looks like over time this thing does get down to its normalized price earnings ratio. It's not guaranteed, but that could be a way to get a little bit more of a margin of safety in the stock if somebody is uncomfortable owning it at these levels. And so let me know, do you own Nike? Let me know in the comments. Is it a stock you think I should consider for my portfolio, which if you've watched the videos, you know I orient towards growth. I do like to keep an eye on dividend stocks and dividend payers, because eventually if tech stocks get too expensive, or as I get closer to kind of the 10-year period of this portfolio and that $1 million mark, then I will consider switching into more stable dividend style stocks. So let me know what you think. Let me know if there's any other stocks, earnings you want me to review. Just let me know in the comments. I try to do subscriber reviews on this channel. Thanks for watching.